Okay, good evening, everyone. So we have the futures opening flat. Friday last week, Friday was pretty nasty. We get another one of those double-digit dumps. And right now, the S&P futures are opening flat along with the Nasdaq and the Russell. Bitcoin is down negative 0.2%. Going over to the internals chart, you can see that on the bottom right hand corner, if we zoom in on the Nasdaq futures, last week we got that pump into the wolf wave target, and it didn't quite reach that target as it pulled back on Friday, and it held above the 6-day moving average. That's the green dot right there, and then you can see the profile or the bands that displaces the 6 and the 20-day moving average. It's still a bullish trend. Okay, so everything that happened on Friday looked like a profit taking or pullback, and it's still holding the 6-day moving average. So this week is going to be a little bit tricky because we have earnings, and then we saw what happened with the Snap earnings. That was like 30% drop. Kind of a similar situation would happen with Netflix. And then we have FOMC on Wednesday. And usually if the market is satisfied with whatever the outcome is on Wednesday, then the following day you get a pretty nasty sell-off if everything was if the market agreed with whatever the Fed did on Wednesday. And if it's the opposite, if the market didn't agree with the Fed on Wednesday, then you get a pump on Thursday. So it'll be interesting to see what happens here in this week, because the earnings is going to be pretty wild. Okay, because I don't think you really want, unless you're really sure about holding a position after earnings into like using a proxy trade, for example. If you got in, so for Snap, that was a 30% drop, so you didn't really have to worry about the theta decay, because the 30% overcame the theta decay, the premium, the premium appreciation was quite pumped into the earnings, and then after earnings was released, all those premiums got wiped out. However, the 30% drop not only provided extra premium appreciation on the puts, but it also paid off a lot more. But that doesn't happen all the time. But what you can do is if something like Snap drops, and then the same type of companies in that same sector, you can use, for example, Metaverse, or AKA Facebook, that could have been used as a proxy to take advantage. I think when Snap was down 30 or 40%, Facebook after hours was down already 5% in the pre-market. So if Monday, usually in a strong market, holding positions over the weekend is 60% of the time ends up becoming a profitable trade. So I don't know what's going to happen this time. We're coming out of a bottom in the market, and we're carving out a bottom, and we're expecting a massive rally into the end of the year right after the FOMC. Okay, so the FOMC is going to kind of be the deciding factor. If they stick with their schedule of their interest rate plans, then everything is predictable. Everyone's expecting the Fed to be consistent, and then the markets are going to be trading in a consistent manner. But if there's some sort of rate hike that was not expected, right? If they increase the rates higher than what the market was expecting, then that's going to cause a lot of trouble, because there is now confidence being lost in the market. So hopefully that doesn't happen in the market. The FOMC is going to be what everyone is expecting it to be, and I think Wednesday will be a bit more tricky than every other FOMC. So right now what I'm looking at is the S&P futures, and what you want to pay attention to here is basically the bottoming process. So some people have said that this market is probably worse than the worst start of from the past 20, 30 years. And I don't know if I agree with that. I think like in terms of when you look at the last time it kind of corrected or crashed, okay, and you can't really tell too much, because if we just do a comparison of the growth stocks, the strong, like the crazy growth stocks like Roku or Shopify, but let's look at Roku. Shopify is already split 10 times. But if we look at the last time that the NASDAQ or the S&P crashed or corrected, was the COVID. And that was about a 34% drop. Okay. And that was a straight down drop. So this is something that was pretty good if you had like a system to capture that. That was a pretty good drop. But when you compare the drop that we're in right now, this is a little bit crazier, because you get these massive swings and also rug pulls. There's a lot of rug pulls in here. But let me just compare this February 24th to the bottom here, which ended on March 20th, 2020. And then go ahead and look at Roku. Jeez, can't even. It's not even an apples and orange comparison. So this is February 2020, March 2020. February 2020. Right. See, the it's a little bit it's quite different, right? So that was the crash, in COVID crash right here, from $150 down to $64. So about a 50% drop. And then after that crash, Roku moved up 736%. Okay, from the COVID crash. That's a pretty crazy turnaround. And then it gave it all back. So it dropped from 486 all the way down to $88. So are we going to go back up $486? Yeah, I think it's possible. I think it's likely that we're going to get a bounce back to 50% of the correction here. So if I go draw the low here and then draw from the 52-week high, and then find the 50% fib extension level, So 50% would be around 255, or wherever this cluster is, which would be around 230. Psychological target would be probably 200. So $200 is a likely target. And if I went into more detail, I don't think I need to go into detail, because you got all these gaps there, going all the way back to 415. So basically, if this is like, it's a little bit hard to digest, but if you try to compare apples to oranges, right? That's the last time it corrected, during the COVID crash. That COVID crash pulled the S&P back almost 40%. And then after the crash was over, it went up 700%, which was crazy. Now, we've pulled back about, in the S&P, we've pulled back about 24%, right? And then let's go and measure this again. And that's 35%. So it's a 10% difference between the crash, these two crashes. This was a pretty crazy crash. This is where everybody was, this was pretty serious stuff, and that actually was the same time Kobe Bryant was in that helicopter crash around this time. Okay, so that was a pretty crazy year. And then when we fast forward to now, like there was a 700% run up on Roku, and then Roku has pulled back from its 52-week high from $500, $489, all the way down to $80. But the S&P doesn't look like it has done that much damage, right? There's not much damage in the S&P. We're kind of comparing two different markets. So maybe if we go to the NASDAQ here, clear all that stuff. Oops. So the NASDAQ crash was here. That's the COVID crash. And then everything, a lot of people made money just buying the dip on that. So now we're back into this. Now the market's in this corrective stage or crash. And why is it a crash? Because if you take a look at a lot of the growth stocks, PayPal, Shopify, a lot of the tech stocks have pulled back on average 46%. Netflix has pulled back 70%. Shopify's pulled back 70%. They've all literally crashed. And you can't really see that in here. And the reason is because the NASDAQ is comprised of not only just the tech stocks, it's got biotech, it's got some other stocks that I don't follow, and it also comprises of the major weighting component is Apple. Apple's got there's a big chunk of Apple in here, and so that's kind of holding this market up. At least in the index, looks like it's doing a lot better than the rest of the market. So if you look at Apple, it kind of looks like it's actually outperforming the NASDAQ. So the NASDAQ, Apple from its 52-week high, which was here, is pulled back as low as 30%, but it's only year-to-date down 16.11. That's not too bad, okay? But if we look at the NASDAQ itself, then it's actually pulled back from January. So it drew down about 33, and then it's down 24. So Apple is outperforming the NASDAQ by 16%. So Apple actually is looking pretty damn good, or holding up very well in this treacherous market. Okay, so let's see what. So right now the futures. Okay, so now they kind of flip now into the red, and what I've noticed is that whenever Bitcoin goes red, the market goes red. And my point of view about Bitcoin is, I actually don't think Bitcoin has a lot of potential. I mean, if in the short term, what I think it's going to have to do is do what it usually does. It's going to put in a higher low, and whenever Bitcoin goes red, the market usually tends to go red. So in this downtrend in Bitcoin, it's been going down from its 52-week high at 69,000. And if we just draw that line in there, it seems like it could bounce right toward that yellow line. But I don't use these lines as a reference or like a major trading decision point. I just look at the trend of these moving averages, and it just looks like it's getting ready to move a lot lower down to 10,000 and 9,000. So if you're a Bitcoin enthusiast and you're looking to buy Bitcoin much lower, then I would say buying at least 1 to 0.5 of a Bitcoin at around 10,000 or 9,700, wherever that gap is. This gap is showing at 9,600. Maybe you can give it a shot there, but ultimately I think it goes straight to zero. I have a lot of friends that have Bitcoin, and they loaded it up. They've loaded up Bitcoin. This friend he's got obviously a different background than me. He's not an engineer. He's a God lover. There's nothing wrong with loving God, but he's definitely a hodler, and he was originally invested heavily into gold, and also follows a lot of YouTube. What are those guys called? I don't know. Max Kaiser. Those people who talk about the U.S. Doom, and I think the United States of America is the greatest country in the world. I don't want to be shorting. I think anytime the market's giving you an opportunity to buy low, I think that's awesome. It's a great opportunity to buy low and sell high. But he essentially was buying gold, which is anti-American, right? It's bad. It's not very. It's betting against the government and betting against the dollar when you invest heavily in gold. And it didn't work out very well for him in the past 10 years of investing in gold. So eventually he switched into Bitcoin and bought in Bitcoin at 5,000 and ran it up all the way up to 20,000 back here. And then it pulled all the way back to 4,000. And that's, he held on to that. And then made it all the way up to 64,000. We had a couple beers at around 40, 46. So he's still holding, and now it's back to 22. And I think he got his family to buying into Bitcoin, right? So I don't really know. I haven't talked to him since. I'm gonna talk to him once it gets down to 9,000, and I'll probably ask him to come on Voice and talk about his hodling approach. And it's pretty straightforward. He just basically believes in Bitcoin more than he believes in God, and that's the definition of a hodler. So yeah, I think it's going to go down to 9,700 if you think Bitcoin has any. There's nothing wrong with buying 0.5 out of Bitcoin, and if it does go back to 100,000, that's an investment right there that you would buy low, and then you probably wouldn't want to look at it for 5 to 10 years, right? This is something where you're not really looking for a short-term gain. You're looking for long-term gain, right? So, but you don't want to put too much in it because it could still keep on going even lower, because the last low it made was around 2,000. So it could break that. And if it does break that, then that's gonna make a lot of people broke. So that's why you wouldn't want to go all in on Bitcoin at point, right here. Like here, you would go in take some risk. Half a Bitcoin at 9,700 would be like $4,800, right? So you don't want to go all in right here. And I don't think you would ever go all in. The only time you would go all in per se would be when Bitcoin was trading at like $100. You'd probably buy, put in 20%, 10%. If you put in $4,000 here, that's assuming, that would be if you're using like $100,000 account, that's like less than 1%. If you're using a $50,000 account, that's definitely 1%, less than 1%. So you don't want to take such a big risk on in an investment in an asset class that has no inherent intrinsic value. This has no intrinsic value. It's actually really, I think it's going to go to zero. But there's people who think it's going to go higher, and I could be wrong. I don't really know, but based on the gaps in the futures. Buying once, if this gap fills, then the idea here is that the gap up here is going to get filled at 35,000. So you buy something at 9,600 and so it crashes here, and then you'll know it crashed because everybody on YouTube will probably be talking about the crash. And then that's the last gap. And then you buy long term, right, with holding for 2 years for 9,600, and then you sell it once it reaches this gap here, 35,000. So that's a pretty good return. That would be a return of 274%. And if it goes down lower, then you can consider, if it goes down even lower, down to $2,000 right here, that would be a double bottom from the previous low back here. Then you would have to force yourself to dollar cost average with another half of a Bitcoin. So you dollar cost average, and that's the simplest plan I can give you. So you buy 9,000 here. You buy Bitcoin at 9,600, and then it drops another, $5,000, and you buy one more at 2,334, and that'll bring your dollar cost average into that position. Your cost basis would be around, what would that be? That'd be $5,000. Okay, so they'd be like right there, and that'd be a good long-term hold on Bitcoin. You would not be dumping all your money into something like this. Okay, so I'm expecting Bitcoin to drop. I think it's pretty sensitive to the interest rates, and as you may know, every time the interest rate has been increasing on FOMC days, Bitcoin takes a big shitter. So it's probably gonna do the same thing and fill this gap here. You can see it's a couple of times. It's been testing this 20,000 and it hasn't done that. I was shorting coin and I was shorting Coinbase unsuccessfully. It was pretty tricky because they pumped it in the morning, but it looks like it might want to short it again. I'll probably want to wait for like a little bit, either stay on the long side of the market and look for the dipping opportunities and looking for that short squeeze. When I look at the market internals, it does look like Monday could be a reversal day because of the UVol devol. That's the volume of the entire market, and it sold off really hard on Friday, reaching one of the extreme limits here. The next limit would be down here. So if it's down to this perforated green line, that's like this is kind of like of an oversold condition in the broad market, and so would the probability of it bouncing still favors the bulls, but it'd be preferred if it was lower here at the second threshold mark at negative 600,000 on the volume, because that's when it's extremely oversold. That's very similar to like a technical analyst looking at an RSI of like 5, right? So people who follow the RSI using it as an oversold condition, it doesn't work very well. It's just, it works very well when you see divergences where something sells off really hard, but the RSI is not moving any lower than the previous low. But when it moves low, it doesn't give you a good idea of whether it's an oversold condition or not. Here, this breadth UVol devol, it actually gives you a really good idea of how the market's what the state of the market is in terms of its oversold condition. So when it reached this, the yellow part here is the capitulation line. The perforated green line is the first threshold level of an oversold condition. And then finally, once it goes down to this green mark, this thick, solid green mark, that's an extreme oversold condition for the entire market. And then you would try to figure out which stocks are extended, giving you a mean reversion trade. So with the VIX, right now the VIX is up 1.16, so that's not a really good sign. And if this continues to trade green and stays above 25, then there's a chance it goes up to the 21-day moving average. That's an ET. So the conditions of the VIX right now seems like it's risk off, and then the Nasdaq is still holding above the 6-day moving average, looking like it's trending, right? And the idea here is if the VIX starts to relax and start going red Monday morning, then what's going to happen with the VIX is going to start to trade green, and then it's going to hit this wolf wave target at 12,853. So this could be a good idea to buy QQQ calls at the open if the VIX starts to relax tomorrow morning. Here's a chart of Tesla. Tesla did do well on earnings, and then it hit the wolf wave target here at 838 on Friday, and then it pulled back. Tesla is obviously a very closely followed stock, and we did make money on, not on the option trade, but on the common shares trade in the retirement account. And we closed it off right at that target. So we not only using the algorithms to help us statistically gain an edge in the position of going into Tesla, which works out most of the time. It doesn't work out all the time. Long-term wise, it will always make money. And if you're planning to kind of retire, then you got to come in with this retirement plan with some sort of strategy. But at the same time with earnings, if you get a wolf wave and the algorithm is moving toward that target, this is a great point to be taking profits and not looking like you want to keep on holding, right? Because there's obviously a gap here at 759, which is going to fill. There's going to probably be a pretty sharp pullback in Tesla all the way back to 749. And it could actually even drop, actually 750, tagging that 8-day moving average, and then maybe proceed to move higher, taking out the previous high here. This would be the previous high, 840, onwards up to the 1,000 mark because of I think there's some sort of split that's being anticipated. So no trade in Tesla, and I don't think I'll be shorting because actually the liquidity in the market is quite weak. And if you get into any option trade, it's got to be like, you got to be in and out pretty fast because the way that the premiums are decaying, they're decaying, like you got to have to, back in the day, some of the moves we get into, they move because of the Fed backing and all the liquidity it was providing. It was a pretty easy option trading environment. But now because of the liquidity issue, you have to, handle like a 30 to 40% drawdown sometimes, most of the time, in order to get a 100% return. And that's not going to be so easy when you're putting in, for some big trades. So you got to position size a little bit more conservatively. Okay, so let's go and take a look at some of these stocks here on the 750R. Mostly I follow 750R. And what we can see here on Apple was doing well. We got into a bullish wave, which was in the trading view. Let me see it. Did I post it here? Yeah, there is. We have a trading view idea that, let me see, I don't know when I alerted this position. Yeah, right here, back on June 23rd. So these wolf waves work great, especially when you can time it with the VIX and so far it's done quite well. You can see the lower low that it was placed in June 17th, and then it got a little tricky right around here on options, which was June 27th, 28th, 29th, and 30th. So what does that mean? Last week of the month, you get some rebalancing, and you get these type of pullbacks can happen, and that's what I think is going to happen this week. So if you look at Apple is a huge weighting in the S&P and the NASDAQ. And if the last week of the month you get rebalancing, so on June 27th down to 30th, so if we go to the calendar here, go June 27th to 30th, you can see that is obviously the last week of the month. And now we're going into the last week of July. And the Apple is right up against, it's already achieved the Wolf Wave target of 153 to 155, whatever it was. Okay, it was around here. And now it's right up against the 200-day moving average. So the target has already been achieved, and there's actually earnings. Okay, that's on the 26th. That would be this week. And if we go into, let me just go back here. All right, so this is a pretty tricky week, because you've got Apple that provided a pretty nice short squeeze, 21% move from its low on June 16th. It's right up against the 200-day moving average going into earnings, which is a binary event. So you can clearly see, and then you got FOMC that's going to be talking about rates. So you can clearly see that getting into an aggressive position in Apple is not going to be working out for you this week. Okay, so this chart right here, like you can see the 21% run up right into the 200-day moving average, and you got a binary event that can go higher or lower. You can clearly see there's a gap at 173, which, you know, Apple could gap up to 173. We don't know. But taking that risk into the last week of the month, where you got rebalancing that happened also in Apple on June 25th, right here, to June 27th, the last week of June. You can see that the trade setup is not in favor for bulls. Okay, so you want to get past this week with little drawdown as much as possible, and then wait for a setup to develop, so that we can capture the next run up, which is going to be a 174 into the end of the year. Okay, so like I said before, the market's going to rally into the end of the year. This is a great opportunity. Actually, we kind of predicted that mid-July we would see like a big rally. And okay, this is a great update on the market, Roger. I haven't been watching yet. Yes, you should definitely get into the 750R. Great opportunity to build your retirement account and get retired ASAP. You don't get these type of market corrections very often. But let's see, where am I here? So we're mid-July, so this is the midterm elections, and I think this midterm election is going to be pretty crazy, because I think, well, I mean, from whatever I'm watching on YouTube, it doesn't look like the current administration is going to stay in office, right? And we need to probably get this market going again. And once the midterm election bottom is in, which I think it was in already based on Apple's move, then we've got pretty much 4 to 5 years of the next bull run in ahead of us. So yeah, with the FOMC this week, I don't think there's really um, much to do. You want to just reduce your risk and then wait for that setup. If there's a setup that I can find that looks juicy, then I'll alert it. Let's take a look at another company, Amazon. So Amazon looks great, right? You can see that big old gap there at 140, and it's got earnings still trending. And actually, the moving averages are all stacked on top of each other: the 6, 8, 21, 50. So this is actually a pretty good looking trade, where the previous high, which was around 116, was taken out, and then you got this other high here at 129 that when it gets taken out, it's going to start filling this gap at 139. Problem is, Apple's already at the 200-day moving average, where Amazon is not. So Amazon will probably go back down, and I think there's a couple of gaps. There's a lot of gaps. Right there, 111. How much of a drop would that be? Well, 10%. Yeah, I don't know. Okay, there's too many gaps. Boeing still trading above the 6 and we got this kind of dark cloud bearish engulfing candle forming, so it looks like it's going to start to pull back and retest that 21. Coinbase looking like I was mentioning that there's these two gaps where I was trying to trade into for this week, but I closed out the position. Netflix is extended. Most likely they're going to pull back to the 6. So everything that I'm seeing right now is just kind of, here's Nvidia that pulled back to the 6-day moving average, but it hasn't reached that target here on the wolf wave, and it's got a gap, and that might be a little bit tricky as well. So ultimately, when I look at the NASDAQ here, I want to see this thing turn green and then see the VIX turn red. If that's the case, then I'll be looking to get into either Nvidia, or I'll be looking to go long into some of these tech names. Like Roku, it got pretty much smashed on Friday, and it doesn't look like it wants to break out and tag that 110 target. Shopify, it ran up quite high and then it pulled back on 1, 2, 3, 4 on the 4th green day, looking to retest that 6-day moving average. Tesla is going to do exactly the same thing like Shopify. It's going to pull back down back to 750 to 778 to fill that gap. Is 750. AMD holding the 6-day moving average, but if it doesn't hold that, it's going to go retest that 821-day moving average. Monster, it's got monster gaps all the way down to 127. So you can kind of sense that if Apple is the mate, so a lot of smart people automatically trade Apple with their systems, right? People are not individually trading millions of dollars of stock on Apple manually. It's all done computationally. So those computational algorithms that they've developed is probably sensing that 200-day moving average resistance, the gap here, 132, earnings, FOMC, everything. So this period right now, from now till earnings here, this is going to be a big question on which way the market's going to go. Now, what the plan is just to avoid it altogether and wait for the market to set up for the next leg up. Okay, so let's look at Snap. Snap got demolished, and I'm just kind of curious why these companies are not going broke or bankrupting or whatever. Like, this is pretty nasty. So this is, you can see the gaps are all the way down to like 650. So, I mean, if you're thinking of getting into Snap because it's buy low, sell high attitude, first you got to look at the company's fundamentals. It's in a competitive market with metaverse, TikTok, and eventually all these things, all these social media platforms, they only serve two purposes. It's to share your photographic skill sets with your family and sharing memories. And the second and most profitable business is just selling used garbage in the marketplace, right? The most popular marketplace back in the day was Craigslist. You could go to any country, go into Craigslist based on your country, which country you're in, and then look for some used goods if you want to buy and sell, over the internet. Now Facebook looks like they're the dominant force in making it more convenient to sell used goods and buy used goods more efficiently than Craigslist. And if that's the model of a social media platform, then Snap, TikTok, and all these other social medias, they're pretty much going to follow the same suit, right? They're going to create a marketplace and then create like some sort of currency that is used among each buyer and seller, and then create their kind of own little ecosystem of garbage and regurgitate that over and over again. So that's what I see. And if Snap's not following that platform, that business model, then it's going to go broke, right? Because there's no real, it's up against a lot. And there's TikTok, there's even other countries have their own little social media platforms, even Korea and Hong Kong, Asia. They've got WeChat. And then Twitter is probably trying to do the same thing. It's in the deep trouble. So I think if these companies go bankrupt, it's probably good for the market. And why it's good is because all that money out of Snap will go into other companies like Apple and Amazon, the strong stocks where they're looking for growth. Okay, so that's pretty much it for the market update. I don't really see anything that looks like it's going to be a big trade. I think all the big trades happen on Thursday and Friday. This week, I don't really see anything that really sticks out. All right, thank you very much for your time, and I've recorded the session. I'll be posting it shortly. Thank you.